Hello and welcome back, or welcome to Miss Finance if this is your first time on the channel. So we've had a request to go through transfer pricing, so that's exactly what we're going to do today, so let's get straight into it. So transfer pricing is needed basically when you've got one business that's divided into more than one department or a division, and goods and services flow between these two divisions. So you might have Department A who trades with Department B. So the system will record the goods or services leaving Department A and going to Department B, and the monetary value involved is basically the transfer price. So if we do an example here, we might have Division A selling to Division B, and we have a transfer price of 25k in Division A, and that's made up of their own cost of 15k and a markup of 10k. So when we look at Division B, they get the 25k transfer price, they have their own cost of 10k, and they also have a profit or markup of 10k on top of that for when they're selling that product outside of the business. So here we can see that Division A made a 10k profit because they added the profit or markup of 10k, and then Division B make a profit of that, whatever the sales price is, minus 45k in effect. So if we go to the second example, we might have an instance where Division A can only sell to Division B, and Division B can only buy part one of a product from Division A. So in Division A, we've got variable costs of 9k, we've got fixed costs of 6k, and a divisional profit or markup of 10k. So they're transferring out that product at 25k. And if we look at Division B, they get the transfer price of 25k, but they've got variable costs of 5k, fixed costs of 5k, and then when they sell to the customer, they add on that 10k for their profit in that division. Now, something key to remember is that 25k in Division A can be no lower than the costs incurred by Division A, because otherwise they will make a loss. So you need to make sure that they're at least the total value of the cost in Division A. So you've got to know that all of this is important because it will affect profits in both Division A and Division B, and if they're measured independently on performance, they will want the transfer price to benefit their particular division more. So an example would be if success is measured on return of investment, or ROI, or residual income known as RI, then transfer pricing is going to affect that calculation either positively or negatively for both Division A and Division B. So each division might rely on performance for their bonus, for example. So if their performance is affected because of the transfer price, then they're not going to be very happy if the transfer price causes them to lose their bonus. So let's have a look at the transfer pricing concept. So if we're looking at this from an overall company point of view, they sell a product for £40 externally. Now, in Division A, they incur £10 of cost per unit. Division B incur £8 per cost of unit. So we sell for this £40 over here, but it means that we're making a profit overall as a company of £22. But if we look at that from an individual division point of view, there are different ways that we can come up with a transfer price that will either benefit Division A or benefit Division B better. So say with cost plus, if Division A had costs of £10 per unit and they added 20% to that, then they would charge Division B £12. So if we did this in a summary, what you'd see is the transfer of £12 in Division A minus their cost of £10, giving them a profit of £2. And then over in Division B, they're getting the sales price of £40 that's been sold externally, but they've got costs internally of £8, and then they've got this transfer price of £12, meaning that they're making a £20 profit. So you can see Division A is making £2, Division B is making £20, which seems a little bit unfair. Now, the main things that we need to remember always with transfer price is that the minimum transfer price is fixed by the transferring division. So in this case, the transferring division is Division A, and that's going to be marginal cost plus any lost contribution. So when you're looking at an exam question and they start mentioning that there might be limited production capacity, or they're looking to sell externally, either from Division A or Division B, then you're probably looking at a question around lost contribution. And the way to work out loss contribution is the sales price per unit minus the variable cost per unit. So remember, contribution is just sales per unit minus variable cost per unit. And then we've got the maximum transfer price. So that's going to be fixed by the receiving division, which in this case is going to be division B. And that's going to be the lower of the net marginal revenue and any external purchase costs. So you're going to have a range between this minimum transfer price and the maximum transfer price. So again, in the exam, they might ask you to work out what that range is, or they might just say, tell us what the maximum is, tell us what the minimum transfer price is. So there's just a couple of other things that we need to consider with transfer pricing, and they are if the division buying the goods, so division B, feels that they are getting a bad deal, then they may look to source the product outside of the group, which would impact division A greatly. And if division A and B are in separate countries with a different exchange rate, then this will also impact any profits made and overall performance and the tax cost to each individual division. So you don't want an instance where division B feels like they're getting such a bad deal that they then look externally to source a product. And we also need to make sure that we're considering at all times any exchange rate, and therefore that what transfer price we're going to agree on between the divisions. So there are some characteristics of a good transfer price, and there are 4 of them in total, I believe. So we've got one that preserves divisional autonomy. So you're going to have decentralisation in a company where managers are given authority to run their own division and set their own transfer price locally, which is better in most circumstances because most of the time managers don't want to be told by group what price they can set, especially when it's going to affect profits and determine other factors later down the line. Secondly, it must be perceived as fair for the purposes of performance evaluation and investment decisions. Thirdly, it must permit each division to make a profit, because you can't have one making a loss and one making a profit. And we also need to encourage divisions to make decisions which overall maximise group profits, which is known as goal congruence, and all divisions must want to do the same thing. So again, you don't want to have a division who doesn't want to use another division as part of the product process and making decisions that might benefit them individually as a division but doesn't actually benefit the company as a whole. So if we take a look at the economic transfer price rule again, this is the minimum fixed by the transferring division, and the transfer price has to be more than or equal to the marginal cost of transfer out of the division. So that allows division A to break even at all points as a very minimum. And the maximum, which is fixed by the receiving division, which is division B in this case, must be less than or equal to the net marginal revenue of the transfer in division. So this allows division B to break even, and it also ensures that group make a positive contribution. So again, contribution, I'm going to keep saying it, is sales price per unit minus variable price per unit. So a few practical approaches to transfer price fixing is we could use variable cost. So you could set the price equal to variable cost, but division A could make a loss if they have any fixed cost, as this approach doesn't obviously include those fixed costs. And performance measurement will also be distorted because division A would make a loss if the fixed costs are equal to £1 or more than £1, and division B would end up making more profit. So if you were to set transfer price at variable costs, there's little motivation or incentive for division A. Now you could look at full price or the full cost approach, i.e. transfer price equals variable cost plus fixed costs. And you could set the transfer price alternatively at market price, assuming that there is a market. But this too also has the risk of encouraging dysfunctional decision making, because as the final selling price falls towards group marginal cost, so it does allow for objective markups and performance evaluation and comparison outside of the business and more accurate investment decisions. But again, is there a market? Can it be accurately measured? So whether you use full cost plus, variable cost plus, or market price, all of them result in fixed costs and profits being perceived as marginal costs as goods are transferred to the receiving division. Which means ultimately that division B has the wrong data to enable it to make an economic decision for the group. Let's have a look in a little bit more detail at variations on variable cost. So you might have variable cost plus lump sum, so like a 2-part tariff. So this would be where division A transfers at variable cost. So you'd have credit division A revenue and debit division B. So division B would account for fixed costs and profit this way. So it would mean that the numbers wouldn't be as distorted for division B when they're looking at performance evaluation. And secondly, we might have dual pricing. So this is where division A transfers at cost plus markup, but division B transfers in at variable cost only. But it would mean that at the end of the month, a journal or an adjustment would have to be made to get those two to balance, because they won't balance at that point in time because they're using different values. But it would mean that performance measurement is accurate. So let's just do an example. So if division A make a product for division B, but they're asked to make a different product this time. Now division B currently sources this externally for £500. Now if we look at the actual payment card here, what we've got is that product Z that they make normally has a selling price of £400 per unit, direct material cost of £100 per unit, direct labour cost of £40 per unit, and fixed cost of £60. The new one has got direct materials of £50 per unit, direct labour of £80 per unit, and fixed cost of £45. And we're not told what that would sell for, but we're asked to use an opportunity cost approach to determine what is the minimum transfer price. Now note that opportunity cost is the value of the best alternative, so there will only be an opportunity cost if the seller does not have spare capacity. Now to work out opportunity costs, we need to take the marginal cost of opportunity, which is this £50 and this £80, which gives us £130. But we need to also work out the loss contribution too. So we need to take this £400 selling price minus the £100 of direct materials, and then minus £40 for direct labour for product Z, and that gives us £260. But what we're also told is that this new product takes 1.5 times longer to make than product Z. So we need to take this £260, which again was the sales price minus the direct materials minus the direct labour for product Z, excluding the fixed cost, and that gave us £260. We need to times that by 1.5, which gives us £390, and now we need to add on the £130 of marginal cost, which gives us £520. That is the minimum transfer price for the new product. And in example 2, Division A makes a tool that they can only sell to Division B. If we look at the price card, we've got marginal cost per unit of £100, a transfer price of £165. We're told total production and sales each year are 2,200 units. Fixed cost specific to this tool is £10,000. And we're told that an external provider has come to Division B and said that they will sell it to them for £140 per unit. So we're asked to work out what would be the impact on group profits if they took the offer and closed down Division A as a result. So we need to look at the increase in variable costs. So we've got £140 per unit for the sales price from the external provider, and then we've got £100 of marginal cost per unit that we know of currently. So if we take this £140 and minus £100, we get £40. So the total increase in variable costs is the £40 times by the units. So £40 times by 2,200 units then gives us 88,000. But if we're going to close down Division A, then we don't have £10,000 of costs anymore, which were the fixed cost. So the actual costs are £78,000, which would impact group profit. So I hope you found this video useful. I know that was a lot of information to take in, but if you did like it, then do hit the like button, consider subscribing, and I shall see you on the next video.